Alright, so let's break this down. Imagine you're at a huge Jenga tournament, and the tower is getting incredibly tall and wobbly. Everyone has placed their blocks, but some people have put them in really precarious spots. If just one specific block is nudged, it won't just fall, it will trigger a chain reaction, bringing a huge chunk of the tower crashing down with it. That's essentially what a liquidation zone is in the world of cryptocurrency. It's a specific price range where a massive number of leveraged trades are set to automatically close. It's a concentration of digital tripwires just waiting for the price to touch them. These zones are created by traders who borrow money to make bigger bets, leverage trading. For example, a trader might use $1,000 of their own money, borrow another $9,000 from an exchange, open a $10,000 position. This is called 10 times leverage. It can amplify profits, but it also dramatically increases risk. To protect itself, the exchange sets a liquidation price. If the market moves against the trader and their initial $1,000 is nearly wiped out, the exchange automatically force sells the position to get its borrowed money back. A liquidation zone is simply a price level where a ton of these individual liquidation prices are clustered together. Think of it like a crowded beach, towels and umbrellas right at the water's edge. A surprisingly large wave forms offshore. If it crashes higher up the beach, it soaks dozens at once. It creates a chaotic scramble as everyone's belongings are washed away. Similarly, when Bitcoin hits a dense liquidation zone, it doesn't just close one or two trades. It triggers a cascade of forced selling that can rapidly push the price further down. These zones act like powerful price magnets. Knowing where they are is like having a map of hidden traps in a video game. For beginners, this explains violent, seemingly random price swings. It's often not random at all. It's a predictable, brutal market mechanic. Being aware of it helps you avoid becoming another fallen domino. Let's get into the nitty-gritty of how this works because it's pretty fascinating. When a leveraged trader opens a position, they are required to maintain a certain amount of collateral, known as margin. Let's say you go long on Bitcoin at $70,000 with 20 times leverage, betting the price will go up. Your liquidation price might be set around $66,500. If Bitcoin's price starts to fall and approaches that level, your position is at risk. When the price finally touches $66,500, the exchange's system instantly triggers a market sell order for your entire position to prevent further losses and ensure the exchange's loan is repaid. You lose your initial investment, and a sell order is dumped onto the market. Now, multiply that single event by thousands. In a liquidation zone, there isn't just one trader with a liquidation price at $66,500. There are thousands of them, all clustered around that same level. When the price of Bitcoin drops and hits that zone, it doesn't just trigger one forced sale. It triggers a massive wave of automated sell orders all at once. This sudden, immense selling pressure instantly overwhelms the buying pressure in the order book. With far more sellers than buyers, the price has nowhere to go but down, and it does so very, very quickly. It's a self-feeding cycle. This initial wave of selling can push the price down even further, let's say to $66,000. But guess what? There's another group of traders, perhaps those with slightly less leverage, whose liquidation prices were set at $66,000. Now their positions are triggered, adding even more forced selling to the market. This is called a liquidation cascade. The first wave of liquidations pushes the price down, which in turn triggers the next wave, which pushes the price down even further, creating a waterfall effect on the price chart. This is why you sometimes see a cryptocurrency's price drop by 5% or 10% in a matter of minutes. The same exact principle applies in reverse for short positions. Traders betting the price will go down. If a lot of short sellers have their liquidation prices clustered at, say, $72,000, and the price starts to climb towards that level, a short squeeze can occur. Hitting that zone triggers a wave of forced buy orders as short sellers are liquidated. This sudden buying pressure shoots the price up even higher, faster, liquidating the next cluster of shorts above it. Whether the price is going up or down, these zones represent pools of fuel that can ignite explosive market moves. Now, let's talk about the biggest players in this game, the crypto whales. These are individuals or institutions that hold enormous amounts of cryptocurrency, so much that their trades alone can move the market. For them, liquidation zones aren't just a hazard to be avoided, they are a strategic tool to be exploited. Whales have deep pockets and access to sophisticated data, so they can see exactly where these dense pools of liquidations are forming. They know precisely where the market's weak points are, and they use that information to their advantage for massive profit. Imagine our Jenga tower again. The whale isn't just another player placing a block. The whale can deliberately and gently nudge that one critical, wobbly block at the bottom, triggering a cascade that brings the structure down. If a whale sees a massive liquidation zone just below the current price, they might start selling off a large portion of their holdings. That initial selling pressure is meant to push price down enough to tap the liquidation zone, the nudge that starts the domino effect. Once the price hits the zone and forced selling cascades, the whale's job is done. They sit back as automated liquidations do the heavy lifting, driving price down far more than the initial sale. Retail panic follows, traders sell in fear, and the price plummets. That's the whale's profit window. At the bottom of this manufactured crash, the whale buys back everything sold and then some at huge discounts. They effectively created a sale for themselves. This is called a liquidation hunt. Whales hunt stop losses and liquidation levels of over-leveraged traders. It's predatory, yes, and calculated to exploit leverage mechanics. You'll often see price sharply move down, wick into a key area, then aggressively reverse. Understanding this helps you spot a manufactured shakeout versus a genuine trend.